You used money today. Maybe you tapped a card, maybe you watched a number change on a screen, maybe you didn't even think about it. But here's the thing. The money you spent almost certainly doesn't exist. Not in the way you think it does. There's no coin in a vault with your name on it. There's no pile of cash sitting behind that number in your banking app. What you spent today was something far stranger and far more interesting than physical currency. And once you understand what money actually is and what banks actually do with it, you'll never look at that account balance the same way again. So let's start with the most basic question that almost nobody asks. What is money? Not what does it look like, not where does it come from. What is it? Money is any tool that does three jobs. It works as a medium of exchange, meaning people accept it for goods and services. It works as a unit of account, meaning you can use it to measure and compare the value of different things. And it works as a store of value, meaning it holds its purchasing power over time, not perfectly, but well enough to be useful. That's it. Anything that reliably does those three jobs functions as money. Gold did it. Shells did it. Cigarettes in prisons do it. The dollar does it. Money isn't a thing, it's a function. And once you see it that way, everything about banking starts to make a lot more sense. Let's walk through how this works in its simplest form. Imagine a small town with one bank. People earn money and they deposit it because carrying large amounts of cash is inconvenient and risky. The bank holds their deposits and gives them the ability to withdraw whenever they need to. Simple enough, the bank is just a vault. But here's where it gets interesting. The bank notices something. On any given day, only a small fraction of depositors actually come in to withdraw cash. Most of the money just sits there. So the bank starts lending some of those deposits out to other people, someone who wants to start a business, someone buying a house, someone covering an unexpected expense. The bank charges interest on those loans, pays a smaller amount of interest back to depositors, and keeps the difference. That spread between what it earns on loans and what it pays on deposits is how a bank makes money. This is the basic model, and it works beautifully as long as everyone doesn't show up asking for their money at the same time. This system has a name: fractional reserve banking. The bank keeps a fraction of total deposits on hand, the reserve, and lends out the rest. And this is where most people's understanding stops. They think the bank is just a middleman shuffling existing money between savers and borrowers. But that's not what's happening. What's actually happening is far more significant. When a bank makes a loan, it doesn't take cash out of a vault and hand it to the borrower. It credits the borrower's account. It adds a number. That number functions as money. The borrower can spend it, transfer it, use it exactly like any other deposit. But the original depositor's balance hasn't changed. They still see their full deposit in their account. So now there are two claims on what started as one pool of money. The bank has, in a very real sense, created new money. Not counterfeit money, not fake money. Functioning money that moves through the economy, gets spent, gets deposited somewhere else, and gets lent out again. This is the money multiplier at work. One initial deposit ripples outward through the banking system, generating multiple rounds of lending and spending. If banks are required to keep 10% in reserve, a single $1,000 deposit can theoretically support up to $10,000 in total money circulating through the economy. The original cash hasn't been copied, but the economic activity it supports has been multiplied through layers of lending and redepositing. This is how the majority of money in a modern economy comes into existence. Not printed by a government, not mined from the ground, created by commercial banks making loans. The money supply is not a fixed pool that gets divided up. It expands and contracts based on lending activity. When banks lend more, the money supply grows. When loans get repaid, or banks pull back, it shrinks. The economy's fuel supply is not sitting in a warehouse somewhere. It's being generated in real time by the banking system, scaling up or down like a resource that only spawns when players are actively in the zone. Now, here's the part that separates knowing the definition from actually understanding the system. Most people assume that banks lend out money that depositors have saved, that saving comes first and lending follows. The reality in a modern economy is closer to the reverse. When a bank approves a loan, it creates a new deposit in the borrower's account. The loan creates the deposit, not the other way around. The bank doesn't need to check if it has enough saved deposits to cover the loan. It needs to ensure it meets regulatory reserve requirements and can manage the risk. This distinction matters enormously because it means the banking system doesn't just store and distribute wealth, it generates purchasing power. Every mortgage, every business loan, every line of credit is an act of money creation. And the constraints on that creation aren't primarily about how much cash exists in vaults. They're about regulation, risk appetite, and the central bank's policy framework that sets the rules of the game. This is also why bank runs are so dangerous, and why they're not just a historical curiosity. If every depositor demands their money simultaneously, the bank cannot pay, not because it's been irresponsible, because the system is structurally designed so that not all deposits exist as cash at the same time. The money is out in the economy, working, generating activity. That's the feature, not the bug. But it means the entire system runs on a resource that's invisible and almost never discussed: trust. Depositors trust that they can access their money when they need it. Banks trust that borrowers will repay. Borrowers trust that the money they receive will be accepted by others. The whole architecture is built on a chain of confidence, and when that chain breaks at any link, the effects cascade fast. This is why governments created deposit insurance and why central banks act as lenders of last resort, not because bankers asked for a safety net, but because the system itself requires a trust backstop to function. You can think of it as the server infrastructure underlying the game, invisible when it works, catastrophic when it goes down. When you understand money and banking at this level, everyday financial news starts reading very differently. When you hear that a central bank is raising interest rates, you now know they're making it more expensive for banks to lend, which slows money creation, which cools the economy. When you hear about a credit crunch, you understand that banks are pulling back on lending, which means the money supply is contracting, not because cash is disappearing, but because fewer new loans are being created to replace the ones being repaid. When you hear about quantitative easing, you recognize it as the central bank's attempt to inject reserves into the system and encourage more lending when banks have become too cautious. None of these are abstract policy tools. They're adjustments to the money creation engine that powers the entire economy. And the interest rate you see on your savings account, your mortgage, your car loan, those aren't arbitrary numbers. They're downstream effects of how the system manages the balance between money creation and price stability. This is also why your relationship with a bank is not like storing gold in a safe. When you deposit money, you're not placing an asset in storage. Legally, you're making a loan to the bank. That deposit becomes the bank's liability and your claim on future repayment. The bank then uses that deposit as the basis for creating more money through lending. You are, whether you know it or not, a participant in the money creation process every time you hold a balance in a checking account. The system doesn't work without you, and it doesn't work the way most people assume it does. If this is the kind of explanation that makes systems click into place for you, this is exactly what 8-bit economics is built for. This episode is one of 5 in the Economics 101 series, each one designed to give you a foundational mechanic that makes everything else in economics and finance more legible. Subscribe if you want the full toolkit. Drop a like if something in this one rewired how you think about your bank account. And if there's a concept you've always wanted explained at this level, put put it in the comments. That's genuinely how I figure out what to build next. Every complex system runs on simple mechanics. Now, you know one more. Money isn't a thing you have. It's a system you participate in. Every swipe, every deposit, every loan, you're not just using money, you're part of the process that creates it. The economy doesn't run on a fixed supply of currency hidden in a vault. It runs on a constantly shifting web of trust, lending, and repayment that generates purchasing power in real time. And now that you can see that machinery, you're reading the game at a completely different level than someone who still thinks a bank is just a place that holds your cash.